and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. On this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, we are joined by Vizo Financial's SVP Chief Treasury Officer, Tim Sustak, and SVP Chief Investment Officer, Scott Wood, to discuss next week's FOMC meeting. Welcome back, Tim and Scott. Let's get started. So, Scott, the Fed held last meeting. Are we looking at a repeat hold for next week? If so, why?
Yeah, good morning, everybody. Thanks, Jaime. So the Fed did hold last month, or last meeting 6 weeks ago, or 5 weeks ago, really, right? They meet next week. So they meet every 6 weeks on schedule. So the next meeting is going to be March the 20th, next Wednesday. And they're widely expected to do nothing. They may change language a little bit. They may set up for rate cuts down the road, but more than likely it's going to be a very, very similar statement to last meeting. No real changes on the outlook as far as the rate cut goes at this meeting. When you look at Fed fund futures, which is kind of the market's take of this, they're giving effectively 0%. I mean, if you look at the odds, it's about a 2% chance of the Fed cutting rates, which is effectively, zero. So the markets, as we've talked about in prior meetings, have been ahead of the Fed quite a bit, thinking we would see more rate cuts. They're finally getting closer to what the Fed is telling them and showing them and doing. The markets don't expect a rate cut. The Fed has given no indications at all that they're going to cut rates anytime soon, as in the next meeting or two. So we expect a repeat, the Fed on hold. I don't want to say indefinitely because they certainly are starting to talk about that. And Chairman Powell had some comments last week when he did his semi-annual testimony before he meets with both, one day with the House committee and then another day with the Senate committee, and then it rotates every 6 months on which one goes first. So he gave some testimony there and some thoughts about cutting rates. He definitely said the Fed plans to cut rates this year, but again, no indication that there's anything on the horizon right now that would force them to do that quickly. So probably later in the year is what we think is going to happen when they start cutting.
Okay. All right. So, Tim, before the start of the year, there were many analysts and economists that were predicting 6 rate cuts in 2024. If that happens, how could that impact credit unions?
Well, I would say I don't think we need to worry about that because it is, not likely at all to happen. I think that, that was really the market getting ahead of itself. The markets are paid to anticipate. And, after December, they viewed, the words of the Fed to be a little dovish and kind of ran with that 6 rate cut story. And, there was never any indication from the Fed that's where they were. That's what they were thinking about. And, to Scott's point, it's taken a while for the markets to kind of come around and start noticing the fact that the Fed never gave anybody any indication that there was 6 cuts on the horizon. So they've kind of walked that back. And I think they're, like Scott said, they're more in concert now with the Fed, which we know, they indicated maybe 3 cuts this year. And, when you look at that, I think, it kind of to build on Scott's points, I mean, the Fed has given us absolutely no indication that they're in any rush to cut rates. The economy is still doing well. We're still seeing growth. The jobs picture, the employment market still continues to pump out jobs. Unemployment was up a little bit at last reading, which is some of what they want to see. They want to see things slowing, obviously, a bit, based on the rate cuts that have already happened. So I think, things are kind of shaping up the way they'd like. Maybe they'd like to see inflation come down, maybe a little quicker. But, to Scott's point about Chair Powell's testimony, as he said, certainly not in any hurry. But, they're getting closer, So what does that all mean? I think, baseline, you'd have to look and kind of believe the Fed as to what they've said. We'll get a new set of projections with the March announcement. So we'll see how much that's changed. That may change a little. You had some of the Fed presidents come out and kind of pushed back in market bid. I think it was, Neil Kashkari came out and said, hey, my projections are probably going to be, for one less cut than what I had originally anticipated. Raphael Bostic came out and said, hey, folks, we're in no hurry. And not only are we in no hurry, but, once we do make that first cut, we'll probably wait a little while, to see what we're going to do next. I think, he kind of wanted to set the tone for, don't think there's going to be a rapid decrease in rates, kind of like you saw the run up, right? And Chair Powell talked about this before as well. When you're at the cusp here of the rate cycle, it's a very delicate game. So you're not going to do anything too fast or too quickly unless some overwhelming evidence comes out to tell you to do that, right? You're going to tweak things. So you might look for a cut and then maybe we'll hold for a little bit and see what that does, maybe another cut. But, to your original question, if we do get 3 cuts this year, like was the projection at last meeting, and we'll see if that's been pared back. But if we would get that, typically rates fall. We do a little better on deposits as credit unions. I still think that, we certainly saw, loan growth back off with the rate rises. The thing with 75 basis points is, given how far we've run up, 75 basis points isn't a whole lot, right? So I think we'll see some changes here and there. We'll start to see changes, but, given we ran up, over 5%, 75 basis points probably isn't going to make a huge dent in anything, but we'll start to see that transition.
All right. Scott, I'd like to get your thoughts. How might fewer rate cuts than anticipated, like 2 or 3 that Tim's talking about, affect the economy and the credit unions?
Yeah, so kind of really on top of what Tim said, 2 to 3 rate cuts. We'll get new projections next week, almost what the Fed thinks, and then that'll obviously impact the markets on their thinking. But if you look at Fed Fund futures right now, they're at 3.5 rate cuts. So they're right on top of the Fed today, which is nice. So as Tim mentioned, normally when we start to see rate cuts, we start to see balances build up at credit unions. Usually what happens is your members will start saving more money, because there's that psychological aspect that, if that part of the cycle when the Fed starts cutting rates, it's usually because there's a little bit of weakness out there. So when we see that weakness, people generally start to save. There's usually less demand for borrowing when that happens too. So the conjunction of those 2 things lead to higher balances at credit unions. But as Tim pointed out, 75 basis point cut over time. Let's say we got 75 this year. It's not going to be super fast. It's not going to be a whole lot. And really at this point, the Fed isn't necessarily looking to cut rates because the economy is in trouble, which is traditionally what they do. They're really looking to cut rates at this point just to kind of engineer a soft landing. They want to make sure that if they've over tightened and they're still letting all these rate hikes kind of filter through the economy, it takes some time for that to happen. I think you could argue that maybe it's been enough time now, but, depending on what economists you say, it could take a little, or listen to it, could take a little bit of time. But so let's say they're given more time for that. To see the impact. And of course, they're still following inflation to see what inflation looks like. If inflation continues to come down, the economy continues to look relatively strong. When you look, you hear anecdotal discussions, as you talk to people in credit unions that talk to their members, there's certainly signs of concern. Inflation, while it's been coming down, we're not deflating, right? So we're not actually giving back these price increases that we saw over the last couple of years. Things are still elevated. People are still using credit cards and home equity line of credits to finance some of these things. Some people are. It's kind of this 2 economies out there. So anyway, the Fed is kind of looking at these things. They're taking them all into account, but really it's an engineer a soft landing at this point in time because the economy has held up when you look at the broad numbers. The unemployment rate picked up to 3.9% last month, still very low, still well below the Fed thought they would be when they started raising rates. They thought they would be in the 4.2 to 4.5 range. So we're still well below that. Again, we're starting to see some signs of weakness in the labor market, but overall it's remaining strong. Inflation continues to come down. So really, if you look at the Fed now, it's to engineer a soft landing. And unless, as Tim said, something out of the blue comes about, and causes the Fed to, to kind of weaker economy forcing them to make moves quicker. But if we only see 75 basis points of cuts this year, or even maybe 50, as some Fed members have alluded to, then it's not going to have a material impact on credit unions. You may see a little bit of deposit buildup. You may see a little bit of weakness in demand for loans. But honestly, as I've been talking to credit unions recently, they have not really seen a decrease in loan demand. What they've done is they're balancing it internally. They're managing it internally with their rates and with their loan approval process. Most credit unions I've been talking to have told me that they could easily increase their lending volume if they wanted to. There's still a lot of demand out there. So I don't really anticipate major changes for credit unions if the Fed hikes are in that 50 to 75 basis point range this year. Now, if the Fed were to get more aggressive, then certainly we're going to see the things I talked about, higher deposits on balance and, decreasing loan demand. People are going to kind of cut back and tighten up and be a little more careful, but it doesn't look like that's going to be the case. If the Fed does engineer a soft landing, then things are going to continue to look well for credit unions, and then it's really it's really about managing their balance sheet and controlling their loan to share ratio and how much money is out there, by setting rates. So they'll have some pricing and their, availability there. I don't think deposits, we've kind of seen the deposit runoff. This kind of seems like it slowed down at most credit unions where that hot money has kind of already made the move. So the funds that are at credit unions now should be relatively stable, again, unless the credit union takes some kind of action where they want to actively move some of those funds off balance sheet.
All right. Thank you. So Tim, going into the second quarter, what should credit unions be paying attention to?
Yeah, so I think two broad areas. Number one is obviously listen to the Fed. Watch the key indicators that they watch. Inflation, stats around the jobs market, and listen to the Fed. Don't listen to the markets. But obviously, for all the reasons Scott mentioned, general direction of rates is something we always want to pay attention to because it affects everything that we do. So I think, number one is that. So you're prepared for whatever happens there, whether it's higher rates for longer, whether it's, a speed up in the slowdown, what have you, because that's going to affect how you manage the rest of the balance sheet. And then, the other thing, and Scott, talked about it here in his last answer is, typically the second quarter is when we start to lose a little bit of liquidity, right? I mean, the easy money of the first quarter starts to slow down. We all grow end of February, March, beginning of April timeframe. We all take deposits in, and that's a great thing. Gives you a little bit of a break from having to worry about liquidity so much. But then going into the second quarter into the summer months, we have to start thinking about that again. So I know credit unions, to Scott's point, when he talked about how they've kind of, shut off some loan demand with the moves they've made and how they're lending and rates and things like that. I think credit unions have done a really good job on the whole of, kind of managing through this liquidity crunch. I mean, it came at them fast and furious, and it took a little while to catch up for most. And rightly so, given the rapid rise in rates. But I think people have made adjustments, right? They've adjusted their rates. They've adjusted their lending policies. They've adjusted, how they are managing their inflows and outflows. How they may be building cash stores rather than investing. So, they've made their adjustments, so to speak. So I think it's, keeping an eye to that, to Scott's point, what's happening with your membership? Are they feeling any pain, more so, greater or lesser than anybody else? That's going to affect obviously what your liquidity does as we go into the second half. So really just kind of paying attention to all those things. If we get a little bit of a backup in rate, that could help some asset values depending on where your investments are at in the yield curve. So that, hopefully could free up a little bit of liquidity for you that you hadn't had because, the values were so far below par, and you kind of couldn't, stomach taking the losses on those. So kind of all those things going into that second quarter will be really important to pay attention to, just to kind of see where you're at with liquidity and see what the Fed plans on doing. So.
All right. Well, Tim, regarding liquidity, I mean, we've over the past several months, credit unions have been saying that they had tight liquidity. Are we still seeing tight liquidity at credit unions?
I think for some are still struggling a bit, but I think generally overall things have gotten better. To Scott's point, I think a couple things. Number one, that hot money. Scott's point is probably gone, so deposits are probably a little more stable just in general. Loan demand has come down some, whether that's because of rates or whether that's because of what you've done internally. So that's helped, and they've made their adjustments with their liquidity tools. But two, it's just that time of year, like we talked about, right? I mean, March is generally pretty good for all of us from a liquidity perspective. So I can just, just kind of anecdotally looking at borrowing from our members, we are at the lowest that we've been borrowing since, pandemic times. So that stress that we saw with borrowing really shooting up, as rates started to rise and credit unions started to feel that crunch, that seems to have backed off, and people seem to be in a bit more of a balance. To Scott's point too, talking with credit unions, things seem to feel a little bit more manageable right now. So we'll see. Like I said, this is a time when it's going to feel that way. We'll kind of get a true picture on, I think, whether we're through the worst of the liquidity crunch, which I think we are. But we'll get a better picture of that as we go through the summer months, and see where things are and how much stress, that normally stressful liquidity time brings. So, but I think we're through the worst of it.
Okay. All right. Well, I'll ask again come those June, July months. So Scott, what else would you like to share with our audience today?
Yeah, so I think, what Tim has been talking about in his last question, about liquidity and everything, obviously that's going to be key. We're still trying to figure it out here, based on the balances we see, obviously, as indication of what credit unions are seeing. Pre-pandemic, we had one level in our balances. The pandemic hit, deposits came in because of all the different government programs, and they ballooned, right? A ton of money came in. So we more than doubled balances here, more than doubled, which is really unbelievable in such a short period of time. Obviously, that money has mostly filtered out of the system. And if you look at some data, then it really all the pandemic money seems like it's as a whole has been spent, right? Overall, it's been spent. And there's no new programs on the horizon. There's nothing new coming. There's no really reason to put anything new out there because the economy seems to be doing pretty well. So what we're trying to do is Tim and I are looking at is our liquidity, which is obviously a reflection of credit union liquidity. So where are we going to be at when this all settles down? This, as Tim said, this is tax season right now. We've got money coming in. The data I saw a couple of weeks ago is tax receipts are a little slower this year than they have been. Money's coming in a little bit later. We're still hopeful that it's going to be, on trend with normal balances, but we're kind of trying to figure out where we're all going to come in at, pre-pandemic, during the pandemic, really high, back down to normal levels, probably a little bit higher than where we were pre-pandemic, though, is what it looks like we're going to end up at. So, we're paying attention to liquidity. You should pay attention to your liquidity, manage that if you need to. As Tim said, most credit unions are in pretty good shape right now, but as things draw down, as we head into the summer months, the traditional drawdowns, and then if the Fed starts to make some moves, keep an eye on that. Continue to listen to the Fed. We've kind of been preaching this for months now, many months now. So just listen to the Fed. They have not been holding back. They've been completely transparent with the markets. They've pretty much been on top. When they say they're going to do something, they've done it. When they say they're not considering that, they haven't considered that. So, and the markets have been back and forth. Again, they're finally kind of similar to the Fed right now, but continue to listen to the Fed members, they're not all voting members. Like Neil Kashkari, who's a pretty outspoken Fed member in Minneapolis. He's always got good stuff to say. He's not a voting member this year, but he certainly has the pulse and knows what's going on. He's in these meetings. He's a big voice. So listen to these different Fed members, voting and non-voting. So what they're telling us, pay attention to the dot plot that's going to be coming out in the new forecast. Continue to some of the key data to look at is still going to be the inflation data. So look at CPI and the PCE deflator. Those are two big ones to look at. CPI actually comes out this week, March the 12th. So we'll get an idea there. PCE is a little bit later in the month. So pay attention to those. And then the other thing I would mention is, Chairman Powell, when he gave his testimony last week, he did say they expect and fully anticipate more bank failures related to commercial real estate. The Fed is bracing for that. They expect it. We're going to see it, right? We know that there's a lot of institutions that have had some issues in that portfolio. So the Fed's aware of that. They're keeping an eye on it. They don't think it's going to get to a point where it's going to be too troublesome. But I would, again, say keep an eye on that. Some vacancy rates. There have been some buildings selling for basic, I read about one building that sold for a big building in the big city, sold for $1. Basically, somebody took over the payments and the debt there. The prior owner was just happy to offload it and move on. So pay attention to those type of things. The impact on credit unions is going to be minimal because they're not really in that space. But for banks, there certainly could be some headlines out there to look at. But I think listening to the Fed is the key right now.
All right. Tim, any final thoughts for our listeners today?
I think Scott said it well. Pay attention to liquidity. Kind of like the Fed says with rates in the economy and fighting inflation, don't claim victory too soon. Continue to pay attention. Again, last day for the Bank Term Funding Program today. So hopefully, if you wanted to continue that funding, you did so and, extended that out. Because that's, as I said, that's something that won't likely be available again. Definitely not now. Who knows what happens in the future? Don't fall asleep at the switch. Continue to pay attention to liquidity, and I know you will because I think overall credit unions have done a really nice job in adjusting and managing their way through this, and something that, quite frankly, wasn't really expected and happened pretty darn fast. So.
Well, as always, thank you both so much for joining me. I always appreciate you taking the time to share your insights with our listeners. All right, this episode of Financial Minds Meet the Experts is brought to you by Vizo Financial's 2024 Financial Strategies Workshops. Vizo Financial's Financial Strategies Workshops are back to give your credit union those strategies to manage your financials and stay ahead of the game. Each one-day event will provide engaging and informative content brought to you by our very own financial experts to empower you with essential financial strategies that go beyond the basics. For more information, visit our website at www.vfccu.org. As always, thanks for listening and make it a great day.